9 a.m. in Shanghai, Shenzhen, and in Hong Kong. You're watching The China Show. I'm Yvonne with David Ingles.
Good morning. We are counting down to the open of markets in Greater China. Let's get to your top stories today. Stocks across the region tumbling quite bad. After the turbulence, of course, on Wall Street, investors are pulling back from riskier assets this Friday. Concerns lingering over stretched AI valuations and the Fed's ability to cut interest rates.
Also ahead, more conversations from the Bloomberg New Economy Forum here in Singapore. Former U.S. Commerce Secretary Gina Raimondo joins us to discuss America's strategic competition with China.
And I'm Annabelle Drawlers in Taipei, where Hon Hai Tech Day is just getting underway this morning. We're going to be speaking with the Foxconn chairman about AI business strategy. That's as the firm partners with OpenAI to design hardware for data centers.
David, what a difference a day makes. We were just talking about this 24 hours ago, about this whole NVIDIA story that was maybe lifting all boats. And now you're seeing one of the most dramatic reversals when it comes to U.S. stocks, I believe, since we saw it back in April. And we're feeling that here across Asia today as we wrap up the last day of NEF here.
Yeah, there was very little indication that the price action we're seeing today was showing up this time. It was complete opposite, mirror image, in fact, when you look at it. In fact, when we went to bed early evening on Thursday, markets were still up. You woke up in the morning, and one of the massive, sharpest intra-session
5% drop on the Nasdaq
swings, right? In about 4 years or so, and the momentum is carrying through quite strongly, as you can see across, particularly the tech-heavy benchmarks, right? So Taiwan is coming in line, we're down 3%. The Kospi index, if this is any sliver of solace out there, was down over 4% at one point. We're now just down 3%, and we are likely going to see some futures and some pressure coming through in the greater Chinese markets when things come back online. On top of all of this, there's the FX conversation with the Japanese complication there around potential intervention, and we've gotten the latest sign yet on that a few hours ago that they might be looking at this.
We have seen some jawboning already, right? That they're talking about these excessive moves when it comes to the yen. This on the back of that core CPI print that we got out of Japan, right? 3%. CPI has been above that 2% target for 43 months now in Japan. So that is kind of ramping up the expectations that the BOJ is going to have to hike, whether it's December or January. You add that, of course, to Takaichi set to unveil her first economic package later on today. There's certainly a lot going on. The bond vigilantes are emerging right now.
Let's have a look at U.S. futures as well to get any indication of whether or not we are seeing some of the pressure abate following the terrible cash market session coming up on your screens very, very shortly. I should also mention, going into the open today, about 27 minutes away, and we're doing well, but we'll see, of course, whether we are or we have managed to ring fence things on the futures front going into the session. We're also looking at some European futures. We'll get to that in a moment, but just to mention as well, we're just about 3% away from entering a bear market on the Hang Seng Tech Index.
Yeah, we'll watch those levels quite closely, right? There are so many theories out there. What's really sparking this sort of sharp turn in risk sentiment, right? Is it really kind of the AI bubble concerns resurfacing? That strong September jobs report that came out of the U.S. as well. Does that basically, we got to write out the possibility or rule out the possibility of a December cut next month from the Fed? And then Bitcoin as well. You take a look at what the price action is right now when it comes to Bitcoin. We are sub 87,000 right now. Is that going to be sort of the first sign of, risk aversion and why people are really now frantically pushing the sell button?
I mean, it has behaved quite clearly as a risk asset.
Oh, we're above 87,000 at least now.
But we're closer to 85.
Yeah.
And we were just at 125 7 weeks back, just to give you an indication of the pullback and the sharp pull. And we are going, of course, into December, and set aside the fund manager survey out of B of A that did still strike a rather bullish tone, because the price action is suggesting that people might be doing something else, despite, of course, having the perception that things might be okay.
Yeah, let's get more now from our Bloomberg executive editor for Asia Markets, Paul Dobson. He's watching all this over there. We're close by in our Singapore office. And Paul, I mean, everyone's been talking about what led to this. What triggered this dramatic reversal that we're seeing across risk assets now?
Yeah, good morning, Yvonne. Well, nobody really knows exactly what the trigger was, but I think that we have some sense of why it happened. And that is still those concerns, not so much about how much money NVIDIA is going to raise from selling all of its chips, but how exactly it's arranging the sales and whether the buyers are going to actually be able to then viably pay for it all and turn a profit on their investments as well, and how long that's going to take for that payback as well. Lots of question marks hanging over things at the moment, and we're seeing people expressing risk in various areas. For example, on some of the data center builders, we're seeing people trading in CDS, i.e., sort of hedging a little bit for the risk that their bond prices are going to sell off somewhat from where we are at the moment. The cost of funding is going to get pushed up, and that's going to make it harder for the whole cycle to actually complete. I think that, actually you're in a great spot over there at BNE forum this week, listening to all of the guests who've been talking about just the massive costs and going through the numbers on stage in some of the sessions that I was listening to, and talking about, how it's basically you would need all of the revenue again from most of the Magnificent Seven in order to justify the expenditure that's coming in these chips. And so that's why I think market has this concern about whether we've gotten a little bit too carried away with the valuations. On the other hand, you have this very positive narrative. We are, heading into a new age where AI is definitely going to be playing an important role in all sorts of different parts of daily activity going forwards. And so that's the trade-off that investors are grappling with right now.
Yeah, Paul, that's a very good point. The fact that when you get an earnings report and guidance of 12 months and people are talking about we will need to see a specific trillion figure 5 years down the road to just make me sleep well at night looking at the current multiple is, I guess, indicative of maybe how far things have become. So going forward, I mean, we're looking at U.S. futures at this point in time. Seems to be stable. The night is young, as we say, 0.3% to the upside there. Is that any indication that things might start to stabilize going into the European morning and going into the U.S. session on Friday?
Well, I don't know. I'm getting a sense of deja vu here, David, because we seem to have had that conversation a few times in the Asia morning, where after there's been that big sell-off in the US market, the futures have been up a little bit again. In our session, I think that a lot of people are paying attention at the moment to a number crunch that came from the Goldman Sachs trading desk, which is talking about the idea that when you see that really big intraday reversal from whatever we had, sort of 1.5% up to nearly 2% down like we had yesterday, in the S&P, most often you get a big rebound the day afterwards, and on average that's pretty expensive. It tends to come in periods of extreme volatility, and this market, the VIX is elevated but not extreme yet, but it tends to speak to that idea that we're in very volatile times and we could spring back again, or we could have another leg down. And I think that, some of the other things that might give you hope, though, are not really there. The US data is absent, for one thing. The Fed, we're pretty convinced now, isn't going to be cutting in December, so that's another support that's gone. And the economy, we're still getting bad reads on the US economy, and particularly the spending by poorer parts of society. And so that is a drag that the market is contending with on top of all of the chip news and volatility there.
Paul, I'm watching Japan. Nikkei is down 2. We're at 157 levels for dollar yen. We did hear a little bit from the policymakers there about the moves that we're seeing, the weakness that we're seeing, that hot CPI print not helping the currency in some ways as well. I'm just wondering, are we really on intervention watch at this point in Japan?
No, I don't think we're on intervention watch yet, but I think that we're starting to hear tick through those levels of rhetoric as the as the government starts to get a little bit more alarmed about the weakness. It's all about the pace of the move, isn't it, for the yen, really, rather than outright levels. Yes, 160 or whatever is sometimes a place where they might think about drawing a line in the sand, but really what they're concerned about is if the move is extremely rapid, and we're not really expressing that at these levels. But I do think, not just the yen, but pay attention to the Japanese government bonds as well, because a little bit like, do you remember earlier in the year, we had this idea of a sell America trade where the dollar was falling at the same time as treasuries, and everybody was very concerned about that. And now we're having that in Japan, where the yen is weakening at the same time that they're selling off in Japanese government bonds. And that's quite a worrying sign. It tells you that the market doesn't feel like it's willing to stomach the Takaichi stimulus that we're likely to see in the budget today. That should be more of a concern for the government than paying around in the currency market.
Paul, fantastic. Thank you. Paul Dobson there with the context going into the Friday session. It's looking bad out there when you look at Asia as we speak. I'm looking at futures right now, pointing to a lower open, not as bad as what we're seeing across some equity markets already up and running, like Taiwan, like Japan, as Yvonne was talking about, and also like South Korea. Also, just to mention, too, we could get somewhat of a, let's call it potentially market-moving midpoint out of the PBOC. There is an opportunity there to backstop some of the risk appetite, or the lack of it at least today, with a stronger fix. The last one came in at 709.05. That's just to mention, of course, the difference there going into the open today. Dollar China on your screen, 711.52. Counting down to the open of trade, 20 minutes away in Shanghai, in Shenzhen, and in Hong Kong. This is the China Show, and you're watching Bloomberg.
I think the Fed does need to go ahead and cut again. You know, when I travel around the country talking to businesses, which I have hit 36 out of 50 states on my 50-state tour before, you know, the Democratic shutdown happened, those business owners are wanting to borrow more money at a cheaper rate to invest in their workforce. That is what they're asking. And so I think another rate cut is exactly what we need to really grow this workforce.
There we go. That was the U.S. Labor Secretary speaking to Bloomberg after the release of what they just, of course, outlined there, the September jobs report, and juxtaposed and almost oxymoronic with that is a call still for Fed cuts, despite, of course, what seemingly is a strong labor market. Meanwhile, speaking of that, Austin Goolsbee, of course, out of the Chicago Fed, says that he is apprehensive about more easing. He spoke to reporters in Indianapolis following the release of the similar data set. Let's have a look.
We've got a series of geopolitical and policy shocks that have come in that are masking, in my view, this underlying, the economy's pretty strong, and I feel like eventually we are going to be back to rates can come down a fair amount. But in the near term, I'm a little uneasy front loading too many rate cuts.
All right, let's get to Neeraj Seth, founder and CEO of 3R Investment Management. Neeraj was formerly a chief investment officer, of course, at BlackRock's Asia Pacific Fundamental Fixed Income team. Neeraj, it's great to have you back on the program. On a day that is so volatile and we're seeing such dramatic reversal in risk assets, I'm just wondering, how are you thinking about year-end and the volatility that we're seeing right now?
So I do think what we are seeing is a mid-cycle correction, and to some extent, markets hitting an air pocket. I don't think it's a turn in the cycle. I don't think we have entered a bear market completely, but the correction is healthy. I do think we will see potentially the vol to stay high as we go into the year end, because there are a lot of factors coming in play. You have the Fed cut, you have the Fed chair announcement, you have the question around the Fed independence, you'll have BOJ coming back in equation, and you have weaker China data. So the confluence of factors, I do think we'll see more vol as we go into the year end.
In terms of the market mechanics, some people have pointed to maybe some underlying liquidity issues. Are you seeing any material signs, or what should we be watching if to just understand financial conditions right now, which could be tightening?
So I think you've seen for the first time, in fact, since April, a little bit of tightening of financial conditions. And what you do need to watch are the correlations. And you've seen a little bit of that breaking of correlations. If you look at last week and a half, you saw the Treasury selling off, you saw gold down, you saw obviously dollar with a little bit of a strength. The risk-off currencies didn't really perform. And you have seen those correlations not exactly what you would expect in a normal functioning market.
How should I be looking at credit stress next year then, given all the factors that you highlighted there? Are we certain signs of credit stress really picking up next year?
So some signs, but I wouldn't say it's broad-based. I would highlight two pockets. You would see that. First is in terms of all the AI spend. You're seeing some of that credit spreads actually showing meaningful move, even though from a very low base. And the second area, which will remain in focus, in my view, is private credit, where we've seen a significant growth. We had few cases of the defaults over the course of last few months. I think there's more to come there, but I can't see a systemic risk emerging from credit stress, but I do see the credit spread in general widening. going into next year.
Can we still at least expect the Fed to come in early in the event we get a more meaningful, if we get a more meaningful sign that credit stress might be starting to?
I think the bar will be high for the Fed to jump in. Now, if you look back in last 20 years, I can look back at 2008 crisis, and you had 2020 COVID, where you had the Fed coming in and providing support for credit, not just for the functioning of Treasury market, but that bar, in my mind, is high. So small amount of stress and widening and some defaults, I don't think the Fed jumps in.
You mentioned about the AI risk in credit markets. I mean, they're raising a lot of money out there.
Yeah.
Did these numbers shock you in any way?
The numbers almost get to a point of being surreal, because end of the day, the question always comes as an investor is the return on investment, and where is the investment return going to come from? It's a bit unclear, and the markets are getting somewhat nervous trying to understand where is that return or the productivity boost going to show up. Now, the challenge I can see is, like any other technology shift that we have seen in history, not investing is not an option for the large players. So hence, this race is going to continue, and you will get winners and losers in this way, the whole race, and the credit spreads will keep reflecting that as you go.
Do you think we'll get meaningfully more supply in credit next year on the back of just the...
I do think so. Okay. If you look at the infrastructure boom around that, data centers, power, everything that's required, I do think you would need to be able to fund it. And now at this point, you've seen that crossover where the funding requirements are much above the free cash flow from a lot of the large AI investors.
Already, and they have a substantial amount of free cash flow.
Yeah. Where are you seeing, is there a good barometer of AI risk in the credit markets right now? People are talking about these credit default swaps around Oracle, for example, as sort of something. Are you finding those sort of pockets, I guess, of stress?
So I think the pockets are not really that clear. Oracle obviously is a little more visible because it's more crossover than the very highly rated larger cap names. But where I think the credit spreads will show up in terms of the reflection is as you see some defaults or challenges picking up as you go into next year. But I don't think we have seen that much as yet. The credit expansion on the back of AI is in the early stages.
Let me ask you about the inflation and the tariff-induced inflation that I think if you were at some of the sessions, I think Gina Raimondo talked about. You know, it's very difficult to reverse tariffs that are already in place. She said she spent hours in the Oval Office talking to Biden, convincing him, can you take down some of the tariffs? And they tend to be sticky. And the reason I say that is now we've yet to really see the pass-through from the large corporates in terms of inflation. Is that something we should expect next year?
I certainly think we should expect that. There was a lot of front-loading. There was a lot of inventory builds. There's certainly a lot of absorption of that cost increase by both the seller and the buyer. The pass-through has started, in my view, and we'll see a continuation of that pass-through that will play through the CPI data in next year. I think the bigger question for the Fed will be the tariff-induced inflation. Do they try to look through it? Versus the services inflation, which is more sticky, which is certainly a bigger headache for the Fed at this point.
In terms of just the private credit space that you talked about, I mean, everyone seems to be piling into private credit these days. Are there risks that maybe investors don't know about, really something that is a little bit more opaque than maybe public markets are?
I think the part which obviously is challenging for a lot of investors, it is a market which is not very transparent, right? There's no mark-to-market on a regular basis. There's no active trading, so you don't have a price discovery. The challenges that you would see is as the underlying businesses, specifically the smaller businesses or the buyouts which were actually financed through the private credit markets, as those businesses slow down because of high rates, the tariff impact, the shift in supply chains, end of the day, credit is credit. It goes through cycle, and the biggest risk in credit is default. And I think that becomes very binary, and you will not find out till it gets there.
Tell us about this new fund that you're fundraising, of course. You've helped, speaking of private credit, helped build, of course, a franchise of private credit in your previous house. What strategies are you looking at? What looks mispriced as you launch?
So at this point, first of all, the strategy is very much focused around multi-strategy credit, so across the credit spectrum in terms of liquidity, country, currencies, and looking at allocating capital where you see mispricings. Right now, if I look at credit in most parts of the public markets, it looks fairly too rich in terms of pricing, which means you're not going to lean too long in these markets. These are the points in time where having the tail risk hedges and some downside protection becomes critical. Private credit is a space from a secular perspective I still think has a long runway. But from a cyclical standpoint, next 1 or 2 years can be tough.
You're seeking to raise about 700 million. How is that going so far for you?
It's going well. It's very well on the way. I think the idea is to obviously start small sometime in the course of next few weeks. And then it's an open-ended structure which actually gives you the runway to raise over the next few years. So I'm in no rush. I think the market is coming your way in terms of opportunity, and you actually want to grow alongside.
Neeraj, it's great to have you. Neeraj Seth, there, founder and CIO of 3R Investment Management, joining us here at day 3 of the Bloomberg New Economy Forum. In terms of the pre-market and what we're looking at here, this is what HSI is looking at. We're watching, of course, if we're going to see that 20%, well, off the peaks, right, of HSTECH, watching those key levels there as well. There you go. Hang Seng pre-market is down 1.5%. This is Bloomberg. Let's head back inside, of course, the plenary there. Ongoing panel that's going on, the spotlight on Europe, in conversation with Kyriakos Mitsotakis, that is the Greek Prime Minister, of course, with our very own Bloomberg News editor-in-chief, John Bicklethwaite.
So there's a way of again, respecting what has already happened while inviting U.S. capital and U.S. interests to invest in Greece. And I think so far we've been successful in doing that.
Slightly more problematic one. You just had President Zelensky visiting you in Athens. This morning we've seen these details coming out of a US-backed peace plan that seems to give Russia a lot of what it wants. I mean, how should we look at that? Is that just a surrender, or is it just accepting the inevitable?
Well, I just looked at the reports, so nothing has been officially communicated to us meaning I think European leaders. I think a lot of the points that I saw are quite problematic in terms of Ukraine giving up territory it still controls. And of course, at the end of the day, we've made it very clear that no deal can be done without Ukraine. And of course, the Europeans need to be part of any discussion regarding the future security arrangements of Europe. And I think we've also made it quite clear that at the end of the day, the most important security guarantee for Ukraine is a very strong Ukrainian army, and that the Ukrainian armed forces need to take responsibility in terms of ensuring that Ukraine, but of course, to a certain extent also Europe.
Right, we will be revisiting the ongoing discussion taking place here at the Bloomberg New Economy Forum. We're just going to do a very, very brief look at markets ahead of the opening bell, and we are set to join the sell-off across global markets with Hong Kong and China coming online. We are on bear market watch on the Hang Seng Tech Index. Plenty more ahead. This is the China Show. Right, good morning. Welcome back. You're watching the China Show. You know, I had a really good 8-hour sleep last night.
Good for you.
Here I am, still on edge. It must be these markets.
Chill,
it must
go.
be the air.
Chill, go.
Chill, go.
We
Without
need that
the
today.
eye.
We might need that today.
we
on
will.
Your terminal.
Well, all the bulls want to watch 53.46. At about these levels, we're down about 2.5% in the early goings on the Hang Seng Tech Index, or about 0.5% more than that probably takes us to those levels. Just suffice to say, we are in bear market watch here as we look at these markets coming online in about a couple of seconds. From now. What are you watching, Yvonne?
Yeah, you mentioned about those correlations between the U.S. and China are actually now in positive, right? Before it used to be the diversification play, China that was. It seems like as this sell-off, this relentless bout of selling continues, it actually means that these correlations are turning more positive now, and China is not immune to, of course, the volatility that we're seeing across these markets. But let's get to Min Min Lo. She's joining us with the market action in Hong Kong.
Yeah, we are seeing this market sell-off, especially in the tech stocks, right? And we are seeing the CSI 300 now 1% lower, participating in this sell-off, but to a lesser extent than some of the tech-heavy indexes in the region, the likes of the Nikkei and the TAIEX. But here you can see the Shanghai and Shenzhen Composite as well, both pointing lower today. Capricorn down about 2.3%. Flip the board, take a look at where we are in the Hong Kong session as well. Bear in mind, we did see the Hang Seng Tech already touching the 200-day moving average yesterday, and we are breaking below that now, which takes us back to the levels that we had last seen this summer, right? Hang Seng Tech off by about 2.6%. I believe we're just about 100 over points away from bear market territory. Hang Seng Tech as well, another day of decline. We're headed for a weekly loss this week. And take a look at all the tech stocks here, all in the red, and HSBC one to watch because the company said that it is now undergoing yet another structural reform, especially in the trading division, as the CEO, George Elderberry, saying that they want to achieve more efficiency and more client connectivity as the company aims to be a debt financing powerhouse in the region. But we take a look at some of the chip stocks in China. Bear in mind that China is a very different story, and yesterday we did not see these chip names participate in the post-NVIDIA rally, and we are seeing a second day of declines here, big declines on Hua Hong Semi, down by 3.6%. Now, what else we are watching in Asia, of course, is the Hang Seng rebalancing that is going to be announced after market close today. And we talk about this every quarter. If you flip the board, we'll show you some of the names that analysts are talking about when it comes to the favorites in terms of the additions to the Hang Seng. Among them would be the XPeng as well as a CATL. But these two are earnings stories that we are digesting overnight because NetEase reported earnings. It was a miss when it comes to revenue and operating profit was down by about 13%. Sasa looking unchanged. It was a net income increase of 55% on year. So pretty solid earnings there, but not much reaction on the stock right here.
Yeah, Min, thank you so much on the markets there. Yeah, Sasa, just to borrow the makeup and cosmetic analogy there, this market needs more than makeup to feel good looking at today. And what it needs, Yvonne, is fast-acting Imodium. Okay, yeah, yes. Okay, I'm looking at how it's really to the downside, everything else. Okay, let's get more context on these markets as we try and grapple with the correlations. So typically on good weeks that, the Chinese equity cohort tends to break away in terms of correlation with the rest of the world. In the last few weeks, with all the vol that's picked up and also the declines, that correlation has snapped back into positive territory. Shout out, of course, to our markets producer, Anthony Stephens, for pointing this out for us, to us. Ian Samson is with us right now, Fidelity International's multi-asset portfolio manager, joining us out of his office in Singapore. Ian, good morning. Thanks for coming on the show, sir, in very last minute. So, if you guys had a morning call today, and I'm assuming you guys did, what was that like, looking at what happened overnight, going into what we're seeing right now?
Morning, David. Morning, Yvonne. Look, we've been waiting about 6 months for a dip to buy, so we can't be complaining too much. For now, this seems to be positioning driven. Crypto obviously down a lot. If you look at baskets of retail favorite stocks, they're down particularly heavily. You're seeing completely unrelated markets to tech acting really weirdly. Like if I look at something like European banks, they were up 6% in 3 days and down 7% in 2 days. They've got nothing to do with OpenAI or fears around that. So this does seem to be a positioning driven washout. So for us, the best defense was ahead of time, owning a lot of puts when they were cheap, being short credit, being some of the less heavily positioned part of the market. For instance, utilities, Japanese mid-caps on stimulus expectations. So really, we're kind of bracing. We're looking to buy the dip in some things that fundamentally the story is still good, but we just felt the positioning and maybe valuations had got a little stretched.
Valuations are getting stretched, but still that buy the dip mentality is there. And it's interesting, right? Because it seems like right now the market is wondering two things: frothy valuations around AI and tech, and the other is whether the Fed can actually cut, or are they actually done? What's the latter part of that discussion looking like among your team now?
There's two things. There's the question around December, and maybe there's the 6-month view. I think looking out 6 months, and that of course includes the new chair coming in, some other replacements or rotations in terms of who will be voting. The overall composition for the Fed looking out 6 months is going to be meaningfully more dovish. We think they will continue to cut interest rates. They started, why wouldn't they continue? So, if we kind of look out beyond just what's going to happen in the next 4 weeks, that is still an important underpinning of markets, the Federal Reserve easing policy. In terms of December, it's clearly up in the air. We had the minutes come out with the Fed quite divided on whether it's a cut or not. Markets are pricing in actually quite a low possibility of a cut now. But if I look at the labor market report last night, you had unemployment up, still over 3 to 6 months, averaging very few job gains every month. And now with markets wobbling, I think there's probably a bigger chance than markets are pricing in that they go in December.
Ian, if you could talk a little bit more about what you mentioned too around you were waiting for months to buy, for a dip to buy. What would you be buying today?
Today, well, that's an interesting question. But the things that we're looking to buy, I think, is kind of tech at a reasonable price. And so there's a few areas that you can look at. I still think Taiwan in this region is probably the best value way of playing the AI story. And we do think AI capex is going to continue for the foreseeable future. What else could we be looking at? I think there's a lot of grid build-out names that are kind of tied up in the AI data center trade. A lot of these names are in Europe. There's also some in the US. The kind of power-up grid names. They've got a lot going on beyond just AI capex, the AI story, and those are pretty reasonably valued for the growth potential, the sort of structural growth there. So those are two areas I'd look at, the kind of grid and electrification names, and maybe some of the tech names in Taiwan.
Ian, I'm guessing this is the time of the year where your team is starting to come up with the outlooks for 2026. In terms of a multi-asset portfolio now, what should I look at as the best asset class to outperform in 2026?
Oh gosh, I'm not sure I should spoil the surprise. And of course, these outlooks always end up being wrong about 2 weeks after they're put. So I mean, our view, I think, is that the underpinnings of markets will remain intact, which is easing policy from the Federal Reserve and continued capex in the AI names. And so I think we're still biased to be risk on going into next year, but you got to be doing it at the right valuation. So still as a team, we're quite cautious on credit where, it's almost return-free risk at this point. So I think probably sticking with that call of being moderately positive on equities and looking to buy on dips. And another area that we really like is emerging market debt, where there's still, that's been holding up really well in recent days. And I think that's because it's kind of uncorrelated to that AI story. It's still good value. And it plays that easing of policy from the Federal Reserve.
Ian, maybe sorry to push you on a forecast because I know you almost just gave us a little bit of a caveat just now, but this is 50-50 anyway. Is the assumption the dollar continues to weaken next year? You mentioned EM debt. Or is there a risk that reverses higher and this causes all sorts of problems across the world?
Look, when I come to a view on the dollar, usually it's about the dollar smile. So is the US going to be so strong, the US economy going to be so strong that it just sucks capital away from the rest of the world? Or is the US going to be so weak that everyone just piles into the US dollar as a safe haven asset? Or are you going to be in kind of the middle of those two extremes where things are okay in the US, the Fed isn't tightening policy, the rest of the world is doing okay? That's usually when the dollar is soft or weaker. And I think looking out to next year, you're going to be in the middle. I think sitting today, we're in the middle of that. The US labor market is clearly loosening. The Fed Reserve is not tightening. I would be biased to a softer dollar. I'm not an uber dollar bear. I don't think everyone's going to be running away from the dollar. I think there's some room for more FX hedging strategically, and it is expensive. But I more just think that there are good carry trades and good idiosyncratic stories away from the US dollar that we'd be putting on, particularly in emerging markets. Within developed markets, it can be, or gold indeed, within developed markets, it can be hard to find a really exciting story, to be honest, in any of the major economies. Maybe the euro as kind of best of a mediocre bunch.
Yeah. Ian, you still think gold's a good hedge?
Yeah, we took some of our gold overweight down from the very peak, but we maintain a significant position. The underpinnings of that, which is very loose policy on both the monetary and fiscal side in certainly the US, I'd also add Japan to that. Investors in China and India on the retail side looking for places to put their money. And of course, that flood of institutional capital reserve managers buying gold. And I think the main thing that had gone against gold was it had become a speculative asset. You don't want gold to be a speculative asset because then it starts to be positively correlated with everything else. So now that we've had a bit of a positioning wipeout, we had a 10% drawdown from the highs. I think it's a safe time to be adding to gold as a diversifier, particularly out of not just the US dollar, but some riskier currencies, something like pound sterling. That can be a really great risk-off hedge for portfolios.
Ian, it's great to have you. Thanks for joining us. Ian Samson, their multi-asset portfolio manager at Fidelity International. And we're watching, of course, how these Hong Kong markets are doing here right now. We are seeing Greater China is joining in on this sell-off, as Dave had alluded to earlier. CSI 300 is down but 1%. Hang Seng is also down close to 2% here. HSTECH, I believe, Dave, you mentioned, we are hitting those levels now. That would lead to a 20% down from the October peaks that we saw.
We got close a few minutes ago.
Yeah.
We pulled back a little bit as we speak. Suffice to say, it's still a very bad day to be in these markets. 53.46 is the level to watch. That's just over 3.5%. That gets us there. Well, as they say, the night is young, and so are all of we. Plenty more ahead. You're watching The China Show. Good morning. Good morning. Welcome back to shows. We're about 15 minutes into the greater market, cash market session, about just 45 into Taiwan. As they say, when the chips fall, and they are falling quite substantially today, the direct ones and everything, the proxies and everything in between. That said, that's a perfect segue into this next segment. OpenAI partnering with Hon Hai, also known as Foxconn, to design and also manufacture hardware for data centers. For more details, let's bring in Belle, of course, our tech correspondent, joining us from Taipei, in fact, today. Belle.
Yeah, thanks, David. This is a really significant announcement. I think you've got to sort of put it in context here, though, because Foxconn already has an indirect partnership with OpenAI. So Foxconn is actually the biggest supplier of AI server racks to Oracle. Of course, Oracle and OpenAI are partnering on Project Stargate in the US. So Foxconn is very deeply integrated into the broader infrastructure rollout and build out that we're seeing in the States today. But this is the first time the two companies are going to be working directly with each other. And the focus here is on really designing the sort of hardware that's going to be needed for this AI revolution. Of course, OpenAI is a company as well that's starting to go in-house, produce their own chip infrastructure, the ASIC chip infrastructure. And so they're trying to move away, I guess, from that reliance on NVIDIA GPUs. So Foxconn will be really key for them to get exposure to that process. So this announcement today doesn't actually come with any sort of purchase requirements, but it will be interesting to see how it evolves, and also how Foxconn plans to develop its robotics push in the US as well, given that it's planning to make this infrastructure in the States.
I hear some violins in the background. I mean, it looks like it's getting pretty busy there right now.
String quartetting.
Belle, it is Han Hai Day. What's going to be the key focus there?
Yeah, well, I mean, orchestral, to be honest, it's been very nice. I have to say a live orchestra, but a live orchestra behind me. But yeah, we are actually setting up. So we're about 10 minutes to go now until Chairman Young Liu takes the stage. I think he's going to be outlining, of course, his partnership with OpenAI. We'll get more details on that. But also how the company is planning to move into new higher value activities. And one of the things that Chairman Young Liu is making a bet on is a move into EVs. And they really think that this outsourcing breakpoint is going to come for the broader EV industry, where they're going to actually do what they did for the PC industry back in the late 1990s and have it happen in the EV space as well. So to that end, the company's also been investing in battery technology that they also see being applied across a range of different industries. But I did speak with the man who's leading that effort. Take a listen. Foxconn's best known for assembling Apple iPhones and now is a major producer of AI servers. But here in the city of Kaohsiung in southern Taiwan, a different bet of Chairman Young Liu is taking shape. His goal is to transform the tech giant from traditional manufacturer into a leader in new, higher margin activities. EVs, digital health and robotics are at the core, all of which require power packs, which Foxconn wants to mass produce. Troy Wu heads up a team tasked with achieving that goal.
In the future, we believe the scale of the battery will not smaller than the semiconductor itself.
But the company faces a tough path ahead, even with production of EV cells already underway. First is materials, with many Foxconn suppliers relying upon China, which has been flexing its grip over rare earths. Then there's competition, not just from across the Taiwan Strait, but also battery heavyweights in Japan and Korea, plus building out distribution channels. So far, Foxconn has just 3 buys for its vehicle product, though it's planning to increase output in 2026. Still, that's not a deterrent for the company, which sees a big opportunity in AI in particular. It already counts hyperscalers like Amazon, Microsoft and Alphabet among its biggest customers, plus Nvidia. Now Foxconn's working on energy storage cells that could become key to managing the huge power demands of AI servers.
For the long-term consideration, a stable power supply for the AI data center is very important for AI data center operation. So battery can play a very, very important role.
There are links to other parts of Foxconn's business.
Currently, Foxconn already take around 40% server market, manufacturing market. Their customer, they always request the better, the safer battery technology and the better efficiency battery technology for servers. So we now currently we work with our BG or subsidiaries who work with the server client.
Foxconn's chairman is optimistic about the business heading into next year and says AI will be the biggest driver. It's too early for batteries to contribute any meaningful revenue, but they are part of the long-term vision. In Taiwan, Annabelle Drulers, Bloomberg News. So I think we really heard it there, that big focus on AI in particular. It's interesting to note, of course, in the context of this partnership that's just been signed with OpenAI. I mean, energy storage systems, they're becoming very, very key to the build-out of AI infrastructure. So again, just waiting to see what Chairman Young Liu says as he takes the stage in, 10 minutes from now. So we're going to be live with more details on that one ahead.
All right, great stuff, Belle. Look forward to that one. Our Asia Tech correspondent Annabelle Drulers is there in Taipei for Han Hai Day. And of course, Belle will be speaking with Young Liu, the Foxconn chairman, later on today about the firm's AI outlook and impact on business. You don't want to miss that one. Plenty more ahead. This is Bloomberg. Some stories that we're tracking for you here this morning. Banks led by Morgan Stanley have finalized the sale of a $589 million in data center bonds by Server Farm. Now, that deal was initially delayed on concerns over the data center's reliance on revenue from Alibaba. Sources say it was extended to address investor jitters and add a new risk disclosure section to documents. HSBC is restructuring its trade division as part of CEO George Elhedery's push to make the lender a powerhouse in the debt financing business. The bank is merging its G10 rates unit with its FX and emerging markets rates and commodities desks and to form a new global macro division. An internal memo also says the derivatives clearing services will be folded into the global equities team.
Speaking of equity markets, coming up on your screens, the rather sorry state of play today. And when you look at across, onshore markets in Hong Kong, relatively speaking, actually, this is relatively unscathed group, with the exception, I guess, of some of the tech and growth plays and momentum names, of course, 2.6% to the downside. On the Hang Seng Tech Index, about a percentage point more than that takes us about to bear market level. I guess we can get to that later on. Hang Seng Index 1.7, of course, some changes. As far as the index is concerned, we can talk about that, I guess, later. Shanghai Comp has now taken out, and we're now 1% to the downside. They're 3,900 now, south of that level. Right, let's set this aside and really have a look at really where most of the damage is so far. I can tell you the Kospi Index at one point was down the most since Liberation Day. So we are talking the extent of those losses we're seeing in some pockets of the equity market today. MSCI Asia Pacific, the index has cut through the 50-day. We are nearing the 100-day moving average. We'll have plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show live from the Bloomberg New Economy Forum here in Singapore. It is day 3. We are wrapping things up here, but still plenty of conversations to come here throughout the next few hours as well. And certainly coming on a day where we are seeing a risk off across these markets and the dramatic sort of reversal that we're seeing when it comes to the AI trade and the like. And people are still kind of scratching their heads and quite stunned what's happened in the last maybe 12 hours or so.
Well, we went to bed at, let's call it 8 p.m. last night. Let's call it 8 p.m. Let's call it 8 p.m. We went to bed, futures were higher, cash market was higher when I fell asleep. When you woke up this morning, you wouldn't know there was a 5% intraday swing to the downside. The biggest one, of course, since about 2021. But yeah, I mean, we were having these conversations around what the trigger was when you look at the correlation snapping back, when you look at Greater China, for example, which was largely uncorrelated to the rest of the equity complex. In the last few weeks, that snapped back together. And as you can see on your screens, we're down about 2.6 on the Hang Seng Tech Index. 53.46 is a level we're tracking there, about 1 percentage point more that takes us into a bear market. Just to delineate that for you, Asia Pacific, we're down about 1.3%. Now, on the musings that Yvonne and I just amused you with, we put those questions to our guests on shows today. Here's what they had to say about today's sell-off.
Look, we've been waiting about 6 months for a dip to buy, so we can't be complaining too much. For now, this seems to be positioning driven. You know, crypto obviously down a lot. If you look at baskets of retail favorite stocks, they're down particularly heavily. You're seeing completely unrelated markets to tech acting really weirdly. Like if I look at something like European banks, they were up 6% in 3 days and down 7% in 2 days. They've got nothing to do with, you know, OpenAI or fears around that. So this does seem to be a positioning driven washout.
What we are seeing is a mid-cycle correction and to some extent markets hitting an air pocket. I don't think it's a turn in the cycle. I don't think we have entered a bear market completely, but the correction is healthy. I do think we will see potentially the vol to stay high as we go into the year end because there are a lot of factors coming in play. You have the Fed cut, you have the Fed chair announcement, you have the question around the Fed independence, you'll have BOJ coming back in equation, and you have weaker China data. So the confluence of factors, I do think we'll see more vol as we go into the year end.
Yeah, some of the conversations we had here in sets with our guests really on the markets seldom. So I think the point that Neeraj was just mentioning, that in case some of our viewers missed that, was to him, this is all the trimmings of a mid-cycle correction. Nothing indicates that we're in the cycle. Of course, we don't know what the Fed's going to do and when they're going to do it, and whether or not, of course, the last two were the last ones of the cycle. And of course, I think Ian just mentioned there, they were waiting for how long? 6 months?
Yeah, for some sort of
for a dip to buy
sort of entry point, and they say now it could be the time to do so.
Yeah.
Because they still think that the Fed is going to be able to cut. Maybe not December, they said, but next year that could be the still a 6-month window where we could look for some sort of easing there from the Fed as well. So this on the back of course, NEF as we wrap up of the last day here in Singapore. Plenty of themes, right? Everything from the U.S.-China discussion and really how Singapore of many economies has actually been thriving in the face of all this geopolitical tension in some ways. We just wrapped up that conversation with the Greek leader there, talking a little bit more about Europe in the face of what this Russia and Ukraine war that continues on as well, and the role that Europe plays. Let's bring in our editor-in-chief, John Micklethwaite. He just came off the stage and joins us now. Thank you so much for joining us.
Well, thank you.
I mean, it's been a great week. What has been some of the surprise takeaways that you've had so far?
I think it's that strange balance, a bit like what you were talking about, although it's very hard to work out what the trimmings were in there. But in general, it's that dichotomy between the economy, especially in this region, still pushing ahead. But there's a massive problem on the geopolitics, which you can see in everything. You can see when you talk to the Singaporean Prime Minister trying desperately to balance between China and America. And then you can see it a little bit with the Greek Prime Minister. Again, an economy that's doing really well, but the issues around him are Ukraine, but also what's going wrong in the middle of Europe. And so it's a very hard world at the moment to be a leader, and especially one where American leadership, I think, has either been too strong, some people might say, but there's a very clear message to the rest of the world that you have to sort these things out together, and that makes life quite difficult.
Did you get a sense that, based on, I think, a conversation you had with Lawrence Wong, for example, right now with the Greek leader, and I think earlier on we had Rishi Sunak also talking to us through this, that following the meeting in Korea between the two presidents, that things are slightly better, things are more certain?
A temporary truce, he called it.
Okay.
It's a temporary truce, but then as you cover regularly on your show, look what happened with Japan and China.
Yeah.
So, yes, it kind of goes forward in some times, but then there's always this kicker coming in afterwards. And I do think there's that element that everything around the world at the moment, or a lot of things around the world, has to be seen through that prism of China and America and how it works. And that is a very difficult thing. So quite normal decisions. Even the Greek Prime Minister, the issue of the port of Piraeus, the oldest port in the world, in some ways, something you associate with the Odyssey or whatever. There, the issue is the Chinese own it. Do the Americans like it? Not much. Here, you look at all the decisions Singapore was having to make about what happens to Chinese money coming here. What do they do about if America withdraws support? It's the same thing again and again, but it's very, very awkward to look through. But yes, I think there has been a slight de-escalation, although with the Japan thing, it's hard to say that completely.
And at what point the U.S. might actually step in that discussion too. But it's interesting what Gina Raimondo mentioned too, that America first doesn't mean America alone. That the message that she wanted to relay coming here to Singapore was that America still wants to do business with this part of the world, and don't forget that. How do you think that message was really, relayed, and the response from the crowd, really?
Gina Raimondo is a fantastic interpreter of that message, but I'm not quite sure that's really the message coming so much from the administration. Yeah. It is. I think it is very much America first from them, and it's sort of sort yourselves out. And Gina had to do that quite difficult job of going around and selling the previous administration's policy towards the region, and that was hard. But with Trump, it's even clearer. It's like you have to get on and do these things by yourself. And I think America, to that extent, it is a very different America. And I think the other thing about alliances, and you see that, I was in Seoul the other day, you see that, and Japan during the time of Liberation Day, is that people, when you're an ally of someone, it's not a question of being like a 70% ally or if you're not an ally if you're that. You're either all in or you're not. And especially you go to Seoul, as you know, you're very close, you've got the DMZ. It's impossible not to think that you either have to rely on America completely or you can't rely on it. And that, I think, that's a very changing dynamic. And you see them going through that. You see the Gulf countries also thinking about that. You see places like Estonia thinking about that. This morning you've got a very Russian-influenced Ukraine peace plan. So I think it is that big element, of what is happening in the back of the world. America's pulling out of it or leaving other people to try and make choices. Right. And that's part of the interest. It's a very interesting world to be a journalist in. Possibly a harder world to be a politician in.
Right. And I think you mentioned during your conversation with Lawrence Wong, like journalists can be unoriginal at some point in terms of being able.
But the problems are still there.
But the problems are still there.
Yeah.
The binary nature of people having to pick a side, and the reason I frame it that way is a big market like India, for example, a big emerging market like India has somehow been able to manage that binary nature of it. Talking about Russia or Ukraine as well. But what does a market like India, for example, fit into all
India
this?
is fascinating. India is where we're taking the New Economy Forum next year to advertise that. But India is in a very interesting position. It is still the great coming power, obviously in terms of sort of GDP per head, way lower than China, way lower than the rest. But it is rising very clearly. And it's becoming another force here. And what's quite interesting is you can look at some things like when Modi met Xi Jinping. It was quite interesting looking at it from a purely American point of view. That was seen entirely through the eyes of what it means for Donald Trump. Are they ganging up against him? How did they work with Putin? What's North Korea up to? But then if you look at it from this region, there are a lot of reasons why China and India, you might argue from most of mankind's history, probably the two biggest economies. There's a very big reason why those two countries should be talking to each other anyway. But at this precise moment, things are dominated by a man from Washington who likes dominating these things. So even India, I think, is slightly caught in that.
Seems like there's much more conversations to come next year from India. John, it's great to have you here.
Thank you
for joining
both
us
very much
on our program. John Mickleswaite there, our Bloomberg editor-in-chief. Let's get back to markets. Certainly that's still a key story here today. Asian stocks really joined the sell-off that really started and quite dramatically overnight in the U.S. Let's get to our Abhishek Vishnoy. He's our senior Asia equities reporter. Abhi, what's going on today? What's your team watching out for?
Well, it looks like, the crowded AI trade has been trimmed to an extent, but nothing to, worry in terms of writing obituary of the AI trade. There was some optimism going into the US session, but it did not sustain. You saw markets actually rising by, a few percentage points, and then then closing by a few percentage points lower. And that shows intraday reversal. That shows that, sellers overpowered buyers. So bears have an upper hand right now. And remember, this is Friday. So if, let's say, US markets close lower on a weekly basis, obviously, this is not a very positive signal for the near term because, technical picture, sentiment seems to be weakening. But if you look, take a step back and look at the, fundamentals part of it, NVIDIA did deliver earnings, so there is no issue with the earnings. The second half of next year, probably, when Powell gets replaced, would be filled with rate cuts. There is also, some semblance that China would be able to maintain its valuations at current levels at least, and there would be some improvement on earnings side. So therefore, there are a lot of these factors out there which are pointing to, this pain being just there for the short term. And even, going into December, I don't agree that year end is going to be really bad. December actually has very nice seasonality for a lot of markets, including some AI powerhouses like Taiwan. So, there would be, this tug of war between bulls and bears. I think December might be positive. And going into 2027, there are a lot more positive things to look at. Now, once US fell, that sentiment is getting aped in, Asian AI trades as well. Korea is down, Japan is down. We are seeing Taiwan also falling by 3 percentage points. HSTECH, which was already into a correction mode, is now moving closer to a technical, bear market sort of milestone. So, things are getting, deepened in terms of selling. but it looks very short term. It looks like a tactical trade rather than a change of regime.
Abby, obviously we're feeling the pain here in the Asia Pacific, as you just enlightened us on there. I look at U.S. futures, though, are seeing somewhat of a, I'm going to call it somewhat of a bounce, because I haven't looked at volumes and really just to underscore whether there's any conviction there. But how would you interpret the positive price action across futures? I mean, is this going to be over sooner than most people think?
For today's session, it still looks a bit weak out there. I mean, given NVIDIA has become the bellwether indicator, I mean, of course, it's a bellwether company, world's most valuable company. If you look at the blue ocean trading, David, I think the stock is still down about 7-odd%. So that is a bit worrisome. So there might be more declines here, but I won't be able to extrapolate that into a very grim future for the markets in the month of December. The next week might see some sort of consolidation after we see overnight falls. That's the base case scenario that traders are building right now. And then from there, we'd see how things evolve. I mean, there would be data points to watch. This is the 21st day of this month. So, we'll see those monthly exports figures coming out from Korea. And then, the December 1st, we'll see the full monthly figure. Yesterday I wrote something. If you marry what NVIDIA has delivered and said about the future to what Korea exports have done in October, a 25% year-on-year growth, this actually is a very confident signal for AI and especially pick and shovel stocks that we have in Asia. So jury is still out, but I'm still hopeful that seasonality, rate cuts, earnings that are coming in would keep this market on a decent footing as we go into December and year-end.
All right. Abhishek, fantastic. Thank you. Abhishek Vishnoi, there, our senior Asia equities reporter, helping us look through this, looking through, of course, the current malaise. Looking forward to December. In the meantime, though, it's still what was it, Guns N' Roses song? The cold November drain is what we're calling it across these markets.
Yeah, and we'll have plenty more conversations really about markets and the like here from the Bloomberg New Economy Forum coming up, including the former U.S. Secretary of Commerce, Gina Raimondo, joining us. This is Bloomberg. Welcome back. You're watching the China Show live from the Bloomberg New Economy Forum in Singapore. Of course, as we wrap up, let's talk a little more about the VC side of things. Yep. Joining us now is Chibo Tang, managing partner at venture capital firm Gobi Partners. The company manages $1.6 billion in assets and has invested in over 400 startups since 2002, and now expanding into countries like Pakistan and Bangladesh. Chibo, it's great to have you here in Singapore. I mean, it seems like you guys have been pretty busy. 7 exits this year. What's the outlook for 2026 look like for you?
Look, I mean, like we hope that the market continues to stay good, and the IPO markets and the secondaries continue to perform. Obviously, there's a lot of talk of bubbles and things like this. I think we just continue to invest in fundamentals and long term. So, as early stage investors, I think we're focusing a lot on frontier technologies, deep technology areas coming out of universities and the like. And so, I think hopefully we'll be a little bit more immune to cycles. And, if the bubble does break, then, at least we'll well set for the future.
I think the point you just made, you're very connected to really what's happening on the ground and all of these frontier technologies. What are the attitudes of these founders right now? How do they feel about the current environment? Because when you look at the public market, there seems to be a bubble. Yeah. But I don't know how does it feel on the ground at that level?
Well, to be honest, at the early stage, most founders are still focused on their own product and building their own companies, right? Okay. And so, they believe in a long-term vision of, where their product will be in 5 years and 10 years. I don't think anyone is really thinking about, an IPO pathway or looking to list in the near term. I mean, I think what they're dealing with now is just trying to find product market fit, trying to think about what is the future of this technology, right? And these days, I think a lot of founders, especially coming out of China, most people are thinking about global markets, right? And so they're thinking about how to set up abroad, thinking about where to expand and how to do that successfully. So, I think these days, I mean, I think it's really the public market investors, institutional investors that are more worried.
Given the whole AI story, I'm just wondering, we talk about the amounts of money that's been sloshed around, how people are, tens of billions of dollars that are really being thrown into it.
Yeah.
Do you feel like there's just too much money chasing too little deals right now?
I think that obviously there has been a narrative that's been spun in the U.S. and I think the U.S. has capital markets that are very deep. And so there is a lot of money that is going after some of these, more talented or, the entrepreneurs with the strong backgrounds and, the track records and all this. I think obviously here in Asia, the capital markets are not as deep. And so, there's less money, but, they're still chasing these strong founders and people with the backgrounds. I would say that, because there is less money out here, the founders and the startups are trying alternate ways to bring these products to market, right? And so it's not necessarily bigger is better out here. I think everyone's trying to find the best use cases, the best industries, and alternate pathways, right? And so I think that's something that we're seeing. And, with this creativity, I think there will be new breakthroughs.
I'm not sure if you were there was one of the discussion in the panels, I think it was yesterday or the day before, first day, Mark Rowan of Apollo had a very interesting comment. I want to get your thoughts on that. He said, the private markets have changed substantially over years, in that, to Yvonne's point, there's been a lot of money, a lot of interest going into that. And, as a private company, you now have the option of staying private for longer because you're able to raise, frankly, the same amount of money in the private markets that you would have as an IPO. How does that, have you observed any of those trends in your world, and how does that change things for a player like you?
Yeah, no, for sure. I mean, I think obviously for companies that have been able to grow to a certain scale and have been able to prove out their business model, I think that they don't have that much pressure, especially if they have a very strong cash position. Either they're revenue generating, they're turning EBITDA profitable. And I think then they have a lot of interest on the secondary markets, and so even with earlier stage investors that want to exit, they actually can generate enough interest on the secondaries so that they can help facilitate those transactions. So they actually don't need to list. And so I think with more in certain market kind of prospects, I think these companies will choose to stay private for longer. Although, I was speaking to some entrepreneurs the other day, and they're just like, there are other benefits to listing, right? I mean, like in terms of added credibility, in terms of, access to more different sources of capital. So, I think every company will have its own situation.
Sure.
Tell us a bit more about this partnership that you have with the Hong Kong Investment Corp, the Sovereign Wealth Fund, also with the universities when it comes to kind of this technological transfer and the like. Why focus on universities and these deals?
No, so we've been very lucky, obviously. I mean, like we've been, I've been based and operating in Hong Kong for about 10 years now, one of the earliest investors in the space. I think as a key proponent of that ecosystem, we've been very lucky now to partner with the HKIC. And, this year we actually announced a new fund focused on the Hong Kong university ecosystem. And, that's an area where we feel like there's a lot of opportunity going into the next decade. This day and age, I mean, deep tech is the future, right? And so a lot of that deep tech will be driven from IP and the R&D efforts of these universities over the last few decades. There haven't been that many success cases in terms of commercialization here in Asia versus what you see at MIT or Stanford. And so I think that there is a huge opportunity here where Hong Kong is now home to 5 of the top 100 universities in the world, right? And those 5 are all in the top 10 in Asia. So Hong Kong universities rank #1 in Asia, and I think that there is a lot of opportunity here. Going forward, we only see these universities continue to get better because there's a lot of talent coming back, right? And so whether that's from the U.S. or from other parts of the world, I think everybody is seeing the opportunity and the the government support and the institutional support out here, and so that draws a lot of talent back. And I think that will be a very interesting opportunity set going forward.
Was that the thing that changed, that the talent that's coming back? Because we were trying to pinpoint what the pivot point was, and suddenly, Hong Kong was known as a traditional finance hub, not so much as a tech startup hub.
Yeah.
And now, of course, people like you are looking at this. So
Yeah, no, I
wonder
think
what's
it's like a confluence of a few different factors. Obviously, the talent coming back is one important one. But I think, you know, the government in Hong Kong has also just been very good in putting together all these ancillary programs and subsidy programs and grants, and, you know, just being able to be active in funding this commercialization wave. The universities themselves are putting together their own funding programs, investing in their own ecosystem. And, you know, from the private market side, yeah, there's been a lot more interest in investors from not only Hong Kong, but, you know, from China and even the rest of the world to come in and look at these opportunities. So, you know, these days, I mean, like we're investing in very early stage startups, but very quickly they're able to attract other investor interest. They're doing 2-3 rounds in a year. And so we're very lucky, right? I mean, in our fund, we've already deployed in 4 or 5 deals, and, you know, all of them have up rounds already. So it's been a good time.
Chibo, fantastic. Yeah. Thank you so much. Let's do this again, sir.
Of course.
Yeah. Thank you. Thank you. Chibo Tang there, of course, managing partner at Gobi Partners. Lots more coming up here, of course, out of the New Economy Forum taking place. BDA China's chairman is joining us in a couple of minutes, very, very shortly. This is Bloomberg.
$11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break in just a moment. We all need that break, I think, to kind of just wrap our heads about what's been really going on. Nikkei 225 is down some 2% right now. The rest of Asia is doing 1.5% lower here. But really, the bigger, you know, who's bearing the brunt of the sell-off, I would say, is the Japans, it's the Taiwans, it's the Koreas here today. China, relatively speaking, is doing a little bit better. But, you know, Japan itself is dealing with its own sort of issues, right? You're talking about a dollar yen at 157 levels here right now. We had some bit more verbal intervention, I guess, from policymakers this morning.
Yeah, it's complicated today for Japan.
Yeah.
Because we have this obviously broad sell-off. You have intervention risk, which we'll get into in a moment. And then you have the inflation print, and then now you have the central bank governor.
The fiscal package coming out
talking.
Later on.
So
yeah.
it's looking like, actually, when you look at the macro, it does seem more appropriate in terms of to have an assumption that the yen strengthens, given the rates environment and the stimulus at work there. But obviously markets have gone the opposite way, and we're at 157, 158. Let's bring in Brian Fowler, our North Asia government senior editor, joining us out of Tokyo to discuss all of this. Brian, why don't we start with yen intervention, which obviously happens on a spectrum, and where do you think we are on that spectrum?
Yeah, so the first thing I would say is these comments are never random. Going back decades, back to the dramatic era of Eisuke Sakakibara, and even before that in the 90s, Japan MOF officials get together in the morning and they decide what the response is going to be to any kind of overnight moves. So the message is choreographed, it's edited to convey a certain feel from officials of how they see the markets. And when things are calm, they'll just say something like, well, we are watching the market every day, which means everything's fine. This morning, Finance Minister Katayama said, ready to take appropriate action if needed, and she said intervention remains among our options. That doesn't necessarily mean that intervention is imminent, but it certainly opens the way for it to happen. She's sent the warning. And I would just say that the last time MOF intervened was in July 2024, when the dollar was around 160. We did have a member of a panel that advises the Prime Minister speaking in an interview that we published this morning, Takuji Aida, saying that he thinks intervention could actually happen before the yen reaches that 160 threshold. So be on alert. One last thing I would say about that is that among the times the BOJ and MOF intervened last time around, one batch came late on a Friday night as Japan was heading into a 3-day holiday. We just happen to be heading into a 3-day holiday now, and it's Friday. All things being equal, who knows? But just want to put that out there.
Yeah, we'll look out for any sort of signs, right? You mentioned long weekends maybe could be the signal. Let's talk about the data that we got, because that core CPI number that we got, I mean, that was quite hot still. And when you add dollar-yen at 157, there is still that threat of stoking inflation given the weakness in the currency. Does this all just support the case for the BOJ to hike soon?
Yeah, it absolutely does. So CPI stays at 3%. It's been at or above the BOJ's 2% target now for 43 straight months. And even today, some of the underlying trends we saw picked up a little bit. We saw service price gains accelerate to 1.6%. And we saw other signs of that the trend is rising. And I think also with the weekend, I mean, that's another good reason to go ahead and lift interest rates. Katayama's remarks this morning didn't really have a sustained impact, and I guess that's because there's a notion that the U.S.-Japan interest rate differential might not narrow as we had thought at one point. There's been some backtrack in terms of forecasts of a Fed cut, and of course some people are thinking that in Japan it's hard for Ueda to hike rates now with the Prime Minister being very in favor of stimulus and putting out this package. And having said all that, BOJ is definitely on the track towards a hike, and really the question is it December or is it in January?
Yeah, it looks like it's going to come, because let me put two things together. I want your take on this, Brian, right? So this massive fiscal package, largest since the pandemic, is about to hit this economy at a time when inflation is high. The last time we had that, and you replaced Japan with the US, we had this massive inflation issue across the world, and the Fed had to catch up and hike interest rates. Talk to us about that spending plan, that number.
Well, as you say, it's the biggest, most ambitious spending plan we've seen since the pandemic, so it definitely should give the economy a very good boost. Another thing I want to say, though, is that Governor Ueda met with Takaichi earlier this week, and he talked about the path of policy. And what he said was it's a normalization path. We're raising interest rates. What we're really doing is rolling back the degree of easing. We're not talking about creating tight economic conditions. We're talking about rolling back the degree of easing. So even if the BOJ were to hike by another quarter point, the rate would be accommodative. And I think she understands that. He said that she understood that view. So that gives the BOJ room to go ahead and hike rates while still staying consistent with the government's push to be stimulative.
All right, Brian, thank you. Brian Fallow there, our North Asia government senior editor, joining us out of Tokyo here this morning. Now to some other stories that we're following in Japan. The U.S. ambassador to Japan says Washington has Tokyo's back in its ongoing dispute with China. George Glass accused Beijing of economic coercion and says some of the Chinese reaction has been, quote, outrageous. He also confirmed the U.S. treaty pledge to defend Japan, including over some islands disputed by Tokyo and Beijing. One Japanese lawmaker told Bloomberg the country should leverage its alliance with the U.S. to counter China's threats rather than seeking quick compromises.
Fundamentally, we absolutely must not yield to intimidation. Once we give in to threats, everything, our economy and everything else, becomes their weapon.
And estimates from China trading desks show Japan could lose out on as much as $1.2 billion by year-end as would-be travelers from China cancel their trips amid the worsening diplomatic spat. Tensions have flared after Prime Minister Sanae Takaichi became the first sitting Japanese leader in decades to publicly link a Taiwan Strait crisis with the potential deployment of Japanese troops. China has dismissed Japan's claim that its Taiwan policy remains unchanged and repeated its demand that Takaichi retract her remarks over the island.
Right, we're about 66, going on 67 minutes into the cash market session, and a quick glance at the big Chinese tech names, and certainly not immune to what we're seeing across the region. We're down about 2.3 on Jingdong, Baidu's down about 6.5, Tencent is about 1.7, and Baba's down about 4%. HSTECH, we're close. Okay, we're now about, let me just do some simple math, which I can't do for some reason.
Like a few dozen points? 20 something points?
About,
yeah.
53.46. That's the level to watch. Okay, that's going to make it simple. We enter a bear market if we close below that level on the benchmark below on your screens. Right. That's just to say, of course, we're pivoting back to a focus on Chinese tech right now. You have, of course, Baba reporting next week, among many, many things, of course, we're tracking, given the fundamental story and this comeback in Chinese tech. Joining us here on set, Duncan Clark, chairman of BDA China. It's a tech advisory firm that's also now opening offices in Japan. And of course, here we are in Singapore. Duncan, good morning. Thanks for taking the time to speak with us.
Thank you very much. We're actually opening an office in Singapore, actually, also in January. So, yeah, the China impact is spreading in terms of looking at what's happening in China. We need to be in places like Japan and throughout Southeast Asia, and also Mumbai, where I'm heading on Saturday.
There we go. So business is picking up. What have you been most busy with, this year?
It's really the China impact, so studying what's happening in China, whether it be open source AI, as we've been hearing with Alibaba and others, obviously starting with DeepSeek earlier this year. It's not so much about money seeking to go into China, although there's some sense that that's coming back a little bit, but limited from the US. But the China impact, understanding China, what's happening there, because it's going to come to you if you don't understand what's happening. That is driving a lot of demand right now.
And when we talk about that DeepSeek moment, it seems like every few months we get a new language model that comes out from some of these AI labs in China now. Is that sort of the new normal that we're expected to see coming through?
Yeah, I mean, people like Mark Andreessen have been saying, 80% of the pitches that come into his office in Silicon Valley are using Chinese, open source AI.
Yeah,
So,
who's going to win though? Is it going to be the tech giants like Alibaba, the ByteDances, or you look at some of these startups like Moonshot, Minimax?
I think if you have the infrastructure, like Ali Cloud, obviously, that's a much stronger proposition. We're seeing the same in the US, by the way. We've seen, look what's happened with Alphabet and Google's, versus, say, Meta, maybe it doesn't have the same sort of cloud business. So the same dynamic is happening in China as in the US, that if you have the infrastructure, you have a home court advantage.
On the China impact that you just talked about now, they're the obvious, they're the not so obvious right now. Let's start with the not so obvious. Like, what do people need to understand about how I feel the China impact in a not so obvious way?
Yeah, I mean, it's interesting. You're just talking about Japan, and I'm spending a lot of time in Japan also. There is a gap in these two very large economies right next to each other. That's been for some time. For example, you don't see Japanese salarymen and a few women going into China anymore. I noticed that when I'm flying between Tokyo and Beijing. And actually, by the way, cheap deals. I hate to say that, but there is this disconnect. We've had that before between China and India. Interestingly now, with what's happening with India and the United States, there's been a bit of a look again from India towards China and China's business.
Again, I think.
Yeah. So it's Asia, as we know, is huge, but there are some interesting opportunities now because of information dissymmetry or the inability, for example, Chinese to get visas to go to India easily. But actually, they need to understand each other. The same is now happening with Japan and China. So I mean, companies like Bloomberg are in a good place, to get the information to where it needs to be. I'm not sort of pitching you for that, but it is true that we're starved for that person-to-person contact. These events are very useful. So I think there is an opportunity to double down on information and insight and more signal to the noise.
I want to reference your book. I mean, House That Jack Ma built. How many years ago was that? 2016?
The book came out 9 years ago, 2016. I'll update it up until 2019, and then, of course, 2020.
So what's? I know I heard you're writing another book. About Alibaba now. What is it going to be? Where do you pick up?
I want to call it AI Baba because, just drop the L. I mean, Alibaba has reinvented itself.
That's the title.
I think, it looks like a spelling error, but hey, let's work with it. But it is amazing how Alibaba was very much a more surface level e-commerce company, one could say, versus a deeper tech. Tencent was more of an engineering company. But now that's no longer the case because of the investments in cloud and this amazing opportunity with open source LLMs that Alibaba is showing. So Alibaba is in a better place from a regulatory standpoint, being a deeper tech company, but it's also in the right place where it needs to be on AI. We'll see what happens with the results next week. Obviously, there were some strange stories last week about U.S. defense issues with Alibaba.
The military connection.
I don't know, but Alibaba is a serious player now in the global tech sphere, as well as this e-commerce giant. It's no longer seen as the e-commerce giant that was losing market share. We're beyond that. Alibaba has now changed the dynamic. And so there's a new generation also of Chinese tech companies coming forward. And you mentioned some, interesting companies. Yeah. So it's a highly dynamic market, very competitive. And a lot of these Chinese companies at early stages want to get out. I'm actually wearing these smart glasses from a company in Shenzhen that is not targeting the Chinese market because it's too competitive. I have what you have now.
What do they do?
I have heads-up display right now, so I have live translation.
I was about to say, because when you move your head, something reflects, and I see a little box there.
So I have teleprompter, I can have transcripts. Yeah, so I'm sorry, but interviewers are going to take on the interviewers. Now, we have the same information you guys have. I kind of see what you're looking at. The point is, this is a Shenzhen company. A guy used to work at Apple, came back to China. So there's a talent explosion in China. Chinese talent is a global good, I would say, whether it be AI or biotech. The U.S.-China tensions have obviously made it very complicated. But China and India together graduate most of the talent in engineering, as we know. So whoever is going to win in this new world will have to tap in somehow to this talent. And that's the game right now.
And it seems like in some ways, investors are rewarding that approach that China has had with open source, is that, it's less advanced chips, but the budget spend is much lower than the U.S. And the return on equity or return on investment seems to be
because
more...
it's cheaper.
Because it's cheaper.
Exactly.
Or free in some reason, in some cases.
Yeah, I mean, there's an English saying, a British saying of, cheap and cheerful. This is like chip and cheerful. Like, China doesn't have the chips. The high end, as we just heard, Mike Waltz was confirming this morning, the Blackwells are not going to go to China. But China's finding workarounds. It's driving innovation. And so the level of activity and drive and the competition within China is so intense. It's creating companies. And the irony is companies like OpenAI are not open, as we know. And indirectly, the Chinese government stumbled into open source models actually being a way forward for them. So it's a very confusing world when the open company is closed and the supposedly closed China is open. I find it very confusing. That's why I need the help of information.
Well, what we've seen this year following the DeepSeek moment is the government's reset its relationship somewhat from the outside when you look at things with the private sector, specifically the tech sector, really as a way to, when you look at a competition between the U.S. and China. In fact, when you look at what the U.S. is doing with Intel, it's almost like the U.S. is also getting involved in their tech sector.
Confusing, right?
Yeah, it's almost like you interchange the names and then you get a sort of more consistency.
Which is the state plan? Anyways.
Ooh, that gets us into something different. But what I get your take is, what do I need to be watching out for in terms of that relationship between the government in China, the Chinese government, and its tech sector?
Clearly, I mean, there was an clampdown, let's say, on the back of the property sector clampdown, the Jack Ma and other tech sector. We saw with zero COVID, it was like three things together. The government ultimately, I think, recognized the fact that it needs to work closer with the private sector. And don't forget, this came on the heels of President Trump's inauguration, where he was literally, his family was amidst the tech titans in the United States. So there's been a shift. I mean, the rise of tech companies to become almost nation states internationally, but within countries, very powerful players. China's, the CCP is not going to sort of hand over the keys to tech companies, but there is clearly a desire to cultivate innovation in this all effort against U.S. attempts to isolate China. So one can argue whether the U.S. is helping or hindering China's rise. It's a bit of both, I would say. But I think governments now realize the importance that AI and other areas like quantum, advanced manufacturing. I mean, China's 55-year plan, which is coming out, it gives you a very detailed blueprint of their ambitions. And, China is run by engineers, as, Dan Wong wrote in his great book, Breakneck. Too many lawyers in the United States.
That's right.
Maybe too many engineers in China. But, maybe too many engineers is better than too many lawyers. I don't know how many in the room here, but to be careful.
Yeah, you can check the glasses for you.
Yeah, exactly.
And how do you see that play out, though, this whole AI race? Is it just going to be something that's decoupled between the U.S. and China? Or do you see that there is going to be some bilateralism in some ways of these two different
that's a great question, and I think that's the essence of what I'm trying to get to in my new book is going to be about how if AI is an American AI for the U.S. and China for China. No, it's actually there's the global South, and even Europe we see, and even in the U.S. buying like open source AI. I mean, Airbnb, for example, is adopting Alibaba. So that's confusing. One theme I'm really interested in now is like the elite may talk about national security and all this stuff, but the Laobaixing, as we say in China, average Joe, the Main Street, they want cheaper robotics, they want better products, EVs, etc. If China is increasingly making stuff that people want, and in a high inflation West, we're going to see some interesting debates, like saying, fine, national security, that's great, but I just want to reduce my cost of living. I want to improve my mobility, for example, with these strap-on robots that you see, So it's an interesting dynamic that China's making stuff that people want. They're making too much of it, by the way. And as a result, they're having to go global very early on, in some cases, foregoing the Chinese market, which is suffering under almost like a K-shaped, the same thing we see in the United States. We see a split screen economy in China with flashy objects, tech, and actually the property market. We just saw yesterday the Chinese government saying they need to stimulate, housing.
The mortgage market.
So both China and the US kind of resemble each other, actually. They have these split screen economies.
Split screen. I like that. Duncan, we could talk all day, but we look forward to the next book.
Thank you.
Of course, Duncan Clark, chairman of BDA China. We're going to take a quick break. Of course, we're going to talk a lot about what's been going on. There's a panel that's underway there here at the Capellas there. That conversation is with the BitDeer Technology CEO, Jihan Wu, speaking with our very own.
You might know her.
It involves design our own code of EDA software. That's very time consuming. It's kind of a delayed, but I still have some confidence that our team may deliver it. And then if we can be successful, we can license such kind of patents to other GPU or TPU designers in the world to reduce the power usage on their chip. And we have also been doing very good on the traditional Bitcoin chip design. We have low problems to improve the power efficiency, even though the innovation, very innovative design methodology may got a delay, may got a risk.
So you're designing those chips and then you're getting it manufactured by TSMC
yes.
in Taiwan.
Yes.
When we talk about all of these companies, the geopolitical risk always keeps coming up. How do you view that?
Yeah, I think we're already in kind of reality that the national security concerns for the major countries overwhelm the pursuit of the economic efficiency. I think we are already in this kind of reality. We adapt to it. So we rely on one side of the supply chain and we operate and we're doing business on one side of the world. So that's a reality we have to accept and we adapt it very well.
And you also have facilities in Nevada that you're expanding?
Yes, we are building up the Bitcoin mining rig manufacturing factory in Nevada. I think that's actually quite unusual back in a few years ago because all this kind of OEM these factories are doing Asia. We already found out it's very different. If we want to manufacture these mining rigs in US, it needs to be more optimized. We need to design more machines. Actually, some of the machines actually are a lot economic in Asia because the labor here is very cheaper and it's much more easier to recruit very good trained workers. But it's very different in the US. The salary is much higher and it's hard to recruit. So those machines in US will be much easier to get the investment paying back considering the context. So we are accumulating experience by setting up such kind of manufacturing. It hopefully can be ready at the middle of next year.
And just quickly as we wrap up, what do you think is the major geopolitical risk and opportunity for you in the next few years?
I think the next few years, the AI revolution.
Should we just say next year because the technology transition is so fast?
I think it will take a few years for the AI revolutions to spread really worldwide. Right now, the AI revolution mostly concentrated in the United States. It's still there. But later we will see the developing countries to catch up in this kind of infrastructure.
All right, we're going to leave that conversation there when it comes to Bitcoin. But here, back in our, of course, TV studio here, we're going to talk more about trade. Our next guest was one of the most consequential architects of recent U.S. economic security policy. We're talking to Gina Raimondo, former U.S. Secretary of Commerce, joining us here. Gina, thank you so much for gracing us with your presence. It's been very interesting. I think your comments this whole week have been quite influential, I think, to this part of the world about this whole America First policy is not America alone.
Yeah.
You ended your last sort of point talking about the uncertainty of tariffs is almost more threatening than the whole tariffs themselves. We're in a one-year truce now between the U.S. and China. Do you think we've gotten much more clarity?
I hope so. First of all, good morning, and thank you for having me. I do believe the uncertainty is an even bigger problem than the tariff level. That being said, a triple-digit tariff is a problem. But you can't expect countries to continue to trust the United States or want to make big investments in the United States or trade with the United States if they think the tariff rate will change, 2 or 3 times a year. Your company can't plan for that. So I hope we're in a truce, to answer your question. I hope that it'll be sort of status quo, at least with China. But the quicker we can get to some certainty, the better we'll be. Now, mind you, I think the president has a fair point, which is to say other countries have taken advantage of our openness and American workers have been hurt. So addressing that issue is an important thing to do, but you need a strategy with clarity and some certainty.
And the message has to be clear. I wanted to ask you, too, what do you think the message is to some of, not just China, for example, countries like Japan, Korea, for example, where, if you think about it, in the end, they ended up with more uncertainty around their tariff conversation relationship with the United States. What message do you think needs to be polished, if it needs to be improved a little bit, or what message do you think the U.S. is sending to its trading partners?
I think it's the wrong message, because Japan and Korea, the 2 examples you gave, are some of our closest allies. And we want, I am of the view that the world is a safer place when America leads. A strong America that as a leader is good for the world. It provides, and if America withdraws, that vacuum is filled in a way that is less secure. And in order to lead, we need partners. In order to compete with China, we need partners. Korea, Japan, Europe, long-standing partners. Now, if you think that they're engaging in unfair trade practices, fine, address it. But treat your allies like allies. These are the countries and companies we want to have, to invest in the United States, for example. And so I think it's a mistake to treat allies and adversaries in the same way, because we cannot compete with China without friends.
And there's been so much talk about where we are in terms of these chip curbs, which we've seen some delays from the Trump administration. Do you see that there's going to be a risk if the Trump administration eventually does allow for the shipments and sales of these Blackwell chips to China?
Look, the devil is in the details. I think the absolute most cutting-edge chips, which we have, which China doesn't have, is a completely different discussion than disallowing sales to China of chips that they already have, right? That just hurts American companies. I mean, I do agree that having the world run on U.S. AI rails is a good thing, right? I think it is a good thing to have diffusion of U.S. chips so that countries all over the world use U.S. models, U.S. data centers, U.S. hyperscalers, U.S. chips. So I think that's fine. The thing that I do quibble with is national security shouldn't be for sale. So if you say, as this administration has said, this chip can't be sold to China, and then you say it can be sold to China if we get a 15% of the revenue, that doesn't make sense to me, right?
It isn't that important.
National security is, you can't put a price on it. It's not for sale. So should these chips be sold? Maybe. Like I said, that's a detailed analysis. I think most chips should be sold because China has that capability already. And why deny U.S. companies revenue? But the thing I strongly disagree with is putting a price tag on the protection of the American people.
We've seen this a very complex, and I'm cognizant we don't have enough time for this, but we've seen the U.S. government get involved in the private sector. The Intel deal, I heard you talk a little bit about that, of course. Just help our viewers understand what you're in favor of. What type of, shall we call it intervention or incentivizing?
Yeah.
How should we frame that? And why do you think U.S. government support is needed at this point in time?
So it's not new. The U.S. has subsidized the agriculture industry, the airline industry, the train industry for a long time. It's appropriate for a government to say these products matter to our national security, and so we're going to provide incentives. Semiconductors is a great example. Everything runs on semiconductors, and we don't make any leading-edge chips in America, or we didn't until recently. And it's a lot more expensive to make them in the U.S. than in Taiwan. So offering a subsidy that's appropriate in a targeted way, I think makes sense for a government to do. I get nervous when it's one-off, when it's over meddling in the market, because then it distorts markets. And what's great about America is our open market system.
You mentioned also this week that you were surprised that the Trump administration was surprised that China was going to use that card when it comes to rare earths.
Yeah.
Are there things that the Trump administration is still overlooking in terms of where China can still weaponize in this whole trade fight? Are there things that we're not talking about right now that concern you?
Yeah, I don't know. You know, I have to believe they're well informed and properly briefed, et cetera. I was surprised that they seemed surprised because it's so obvious. You know, there are certain areas, biotechnology, active pharmaceutical ingredients, critical minerals, rare earths, solar panels, where we just know the concentration is too heavy in China, which, by the way, is a reason to provide government incentives. We're a less safe country if we're overly reliant. So I don't think so. I think we are aware of what those vulnerabilities are. I just think you need to have a strategy. Back to the point about certainty. If we could telegraph to the world, this is what we're trying to achieve, this is our strategy, let's work with our allies. We don't want American workers to get hurt, as they have been, but it can't be this constant, whack-a-mole, transactional, one-off. With the United States of America, we need to have a strategy and a plan.
And a consistent one. I think one of the things you mentioned, too, you've spent hours in the Oval Office trying to convince President Biden to bring the tariffs down, and he said he wasn't going to be the president, I think, that would lose manufacturing jobs. How can the world trust, businesses and investors trust, that even if we do get a consistent and clear message, that message doesn't change and is agnostic of election cycles?
Yes. America is a trusted partner. Right now, the politics and what you're hearing come out of the White House is divisive and uncertain. But as I have said all week, our commercial relationship, the American people, American businesses, American politicians don't want to be isolationist. And these relationships will continue. We just have to get through an unsettled period of politics.
Do you think there could be a balance, though, between some of the short-term goals, like soybeans, for example, with some of the longer-term goals, right? Reducing the U.S. trade deficit, slowing China's tech progress. What's the right balance, do you think, Gina?
You have to do both. You have to do both at the same time. President was able to secure the soybean deal. That's a good thing for American farmers. But, you got to... where the U.S. can chew gum and walk at the same time. I mean, you have to look at the long-term prospects, which requires investment in chips, investment in research and development, investment in talent, and also tariffs or individual trade deals. Because we have to deal with this in the moment. I mean, we're in an inflationary environment in the U.S. It's challenging for the average consumer. We have Thanksgiving next week. It's going to be an expensive grocery bill for most Americans. So we have to acknowledge that and do something about that today while also planning for the long run.
Speaking of, let's call it prices and inflation, do tariffs stay beyond the foreseeable future?
I did not bring my crystal ball to this interview. Tariffs are hard to take off once they're on. When you put a tariff on, you're protecting an industry, you're protecting an American worker, it's hard to take off. So I would like to think the pendulum is going to come back. I do think politics is a pendulum. Yeah. It's one of the features of democracy. It's a feature, not a bug. And I think we'll be in a tariff world for some time. They're hard to take off, but I hope we'll come back to a place of more predictability.
Okay.
I was going to get your take on these Gulf sort of AI deals that were struck this week with President Trump during MBS's visit. How do you think that squares with the diffusion rule during the Biden era? Yeah. And would you approve the sort of, they're talking about 35,000 AI chips to some of these companies. Would you approve that number?
So I'm not in the details specifically, but here's what I would say. Once again, we need allies, right? Tech, who diffuses tech wins. America has the best chips, the best models, the best AI. So we want the world to use that. So as long as the UAE, Saudis, whoever, agree to our security protocols, i.e. they're not going to let the chips get to China, they're not going to let our models get to China, then I think it's a good thing, right? We want allies. By the way, this is how you make friends around the world. These countries want AI for their own prosperity, right? Everything will need AI in the future. So I don't think we want to hold countries back, but they have to follow the rules. They have to have physical security, cybersecurity, no backdoors to China.
Gina, thank you so much for taking the time.
Thank you.
To sit with
Thanks
us.
for having me.
Yes. Let's do this again next
Okay.
time. Meantime, let's run it back. Gina Raimondo there, of course, former U.S. Secretary of Commerce, just now here, of course, in Seth at the Bloomberg New Economy Forum taking place in Singapore. There's plenty more ahead here on Bloomberg Television.